Hey everyone, welcome back to Corporate Decoder, the place where we try to figure out just how much money is being made and lost behind all those fancy corporate words. Today, we're diving into a report that smells like a big change is coming to Kennedy Wilson Holdings Incorporated. Picture this: a company deciding to fundamentally change its future. That is what we're seeing here. Kennedy Wilson Holdings Incorporated has just announced a major deal or plan to be bought out. This isn't just any deal, it is a merger agreement that will see the company no longer stand on its own. So what exactly is happening? Kennedy Wilson Holdings Incorporated and a buyer, let's call them Parent, have signed a deal. Parent has a subsidiary, a sort of shell company called Merger Sub, that will officially merge with Kennedy Wilson Holdings Incorporated. Think of it like this: Merger Sub will disappear, and Kennedy Wilson Holdings Incorporated will continue, but it will be owned by Parent. This is a pretty common way for companies to combine. And what does this mean for the people who own Kennedy Wilson Holdings Incorporated stock? Well, they're in line for a cash payout. Each share of common stock, except for a few specific cases like stock owned by the buyer or stock for which owners have demanded their legal rights, will be converted into cash. The price being offered for each share is $10.9. That is the number everyone who owns the company's stock needs to pay attention to. This cash will be paid out when the merger officially happens. Now, for the preferred stock and warrants, the situation is a bit different. Some will continue as is, but the company's series of convertible preferred stock will be bought back before the merger closes. What about the employees who have stock options and other special stock awards? This deal also affects them. All restricted stock units, both those tied to just sticking around and those tied to performance, will become fully vested. This means employees will get these awards now. Then these awards will be cancelled and paid out in cash. The amount will be the price. Per share, $10.9 multiplied by the number of shares those awards represent. Any special bonus units granted through written agreements will also vest and be paid out in cash, based on the terms of those individual agreements, usually tied to a change of control. The company is saying these payments will happen pretty quickly after the deal closes. Now, this isn't a done deal yet. There are a few hurdles to clear before the merger can be completed. The biggest one is getting approval from the company's shareholders, a majority of the voting power of the common stock. Series A, Series B, and Series C preferred stock will need to vote in favor of this deal. Also, a majority of the votes cast by shareholders, excluding certain special security holders, must approve it. Beyond shareholder approval, there can't be any laws that stop the merger. Regulatory approvals need to be in place, and both sides need to have been mostly honest with their promises and actions leading up to the deal. And importantly, the buyer's obligation to complete the merger isn't dependent on them securing financing. That is usually a big sticking point for these types of deals, so it is good for the seller that this condition is removed. While all of this is happening, Kennedy Wilson Holdings Incorporated has agreed not to actively look for other potential buyers or discuss other deals. They've basically put up a no soliciting sign while this agreement is on the table. Of course, deals can fall apart. Either side can terminate this merger agreement under certain conditions. If the deal isn't finished by the 16th of November 2026, that is the outside date, either party can walk away. If a government entity makes the merger permanently illegal, that is also a reason to terminate. If one party seriously breaks the rules of the agreement and can't fix it, the other can end it. And of course, if the shareholders don't approve the deal, it is over. There are also specific rules if the company decides to consider a better offer, which we'll touch on. But what if the company does decide to pursue a better offer? Well, there is a price to pay if the merger agreement is terminated because the company decided to go with a different buyer who offered a better deal. Or if the deal doesn't close by the deadline and an acquisition proposal was out there, Kennedy Wilson Holdings Incorporated would have to pay a breakup fee of $42,700,000 to the buyer. That is a pretty significant amount, showing how serious this deal is. Now, where is the money coming from to buy Kennedy Wilson Holdings Incorporated? A big chunk of it is coming from Fairfax Financial Holdings Limited. They've committed to provide Parent with a massive $1,650,000,000. This money is specifically earmarked to fund the merger payment, cover other deal-related costs, and even some potential damages if the buyer messes up. It is stated that this equity commitment, once fully funded, will be enough to cover all the required payments, including buying back the series of preferred stock. To make sure this deal gets the shareholder votes it needs, certain major shareholders and holders of preferred stock and warrants have signed voting and support agreements. These agreements essentially bind them to vote their shares in favor of the merger and against any deals that might try to block it. They also can't sell their shares before the deal is finalized, except under specific conditions. These agreements will end when the merger is completed, or if the main merger agreement is terminated. Some important people are not just cashing out. Key individuals including William McMorrow, Matthew Windist, and Incooley, along with some affiliates of Fairfax who are existing shareholders, have entered into rollover agreements. What this means is that instead of taking all their cash, they are agreeing to contribute their shares of Kennedy Wilson Holdings Incorporated stock to the buyer, parent, or its affiliate. In return, they will receive ownership in parent itself. These are called rollover shares, and they won't get the $10.9 per share cash payment. This is a common practice to keep key leadership or major investors involved in the new combined entity. Even before the ink dries on the merger deal, the company is making adjustments to its existing financial agreements. They've amended their credit agreement to deal with the upcoming change of control that the merger represents. This is standard practice to ensure everything aligns with the new ownership structure. And to keep the public informed, Kennedy Wilson Holdings Incorporated and Parent have issued a joint press release to announce this merger agreement. It's a way to officially put the news out into the world. Finally, this report lists all the official documents that support all these agreements. It is like the legal appendix to this whole situation, detailing the merger agreement, voting agreements, rollover agreements, and the credit agreement amendment. This report also mentions that the company will be filing more detailed documents like a proxy statement and a Schedule 13E-3 with the Securities and Exchange Commission. These will be crucial for shareholders to get all the information they need to understand and vote on the deal. Now, let's step back and look at what this all means. Kennedy Wilson Holdings Incorporated is essentially being taken private, or at least being acquired by a larger entity with substantial backing from Fairfax. The $10.9 per share offer represents a specific valuation that the acquirer believes is fair. For existing shareholders, this is a chance to get cash for their investment, or for some. A chance to roll over their investment into the new parent company. The fact that the deal is not subject to a financing condition is a strong sign that the acquirer, particularly with Fairfax's massive commitment, is very serious about closing this transaction. The large breakup fee also signals a high degree of commitment from both sides. However, it is worth noting that the entire process hinges on shareholder approval. While some key shareholders are rolling over their equity and others are contractually obligated to vote yes, the broad base of public stockholders needs to agree. The information about the proposed transaction will be detailed in the proxy statement, and it is crucial for investors to read that carefully. The inclusion of rollover agreements and the significant equity commitment from Fairfax suggest a well-structured deal backed by substantial financial resources and a desire for continuity from key players within Kennedy Wilson Holdings Incorporated. The company direction is clearly shifting towards being part of a larger privately held entity, moving away from being a publicly traded company. This often happens when a company's management or a major investor believes the current market valuation doesn't reflect the true worth, or when a strategic consolidation is seen as beneficial for long-term growth and efficiency. The risks for investors who don't sell are that they will no longer be able to participate in the company's future earnings and growth as a public shareholder. Alright, that is our breakdown of Kennedy Wilson Holdings Incorporated's big merger news. What is your take on this deal and what it signals for the company's future? Do you think the $10.9 per share is a fair price? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate filings. Don't forget to check out the Discord in the description to continue the conversation. Thanks for watching, see you next time.